Ladies and gentlemen, let me ask you a question that cuts straight to the heart of this moment. What happens when the system built to look invincible quietly asks for help? What happens when the institutions that lecture the world about stability, risk management, and confidence suddenly knock on the door of the central bank? This is not just a headline. This is not just another number flashing across a financial screen. This is a signal, and signals matter to those who are awake, prepared, and thinking independently. Today's title may sound dramatic. It's over. Banks tap the Fed for $17 billion as silver shorts implode. But beneath it lies a powerful lesson about leverage, truth, and opportunity in times of stress. When banks turn to the Federal Reserve for emergency liquidity, the significance extends far beyond the headline figure of billions of dollars. This is not a routine operational maneuver. It is a profound signal of underlying stress within the financial system. Banks operate on trust, interbank lending, and market confidence. And when these channels begin to constrict, it signals that confidence has started to erode quietly but decisively. Liquidity challenges do not emerge spontaneously. They are symptomatic of deeper imbalances. Stretched balance sheets, concentrated exposures, or sudden shifts in asset valuations. When a bank opts for central bank support over regular market funding, it is effectively broadcasting that conventional mechanisms are failing to provide adequate security, and this is the first clue for observers who know where to look. The hidden hook lies in understanding that liquidity is not merely about holding cash. It is fundamentally about belief in the stability and reliability of counterparties and the market itself. Banks can possess billions in assets on paper and still confront immediate funding pressure if those assets cannot be quickly monetized without incurring losses. Even instruments considered safe are subject to market revaluation when interest rates rise, credit spreads widen, or derivatives exposures accumulate. Duration mismatches, where long-term assets are funded with short-term liabilities, magnified as fragility. The moment counterparties perceive that risk is elevated, hesitation replaces trust, and hesitation is enough to halt the smooth functioning of a system designed for constant flow. This is why emergency liquidity demand often spikes abruptly rather than building gradually. Confidence rarely erodes in a linear, predictable manner. Another critical dimension is the role of the central bank as a backstop. These emergency facilities exist not for convenience but for systemic containment. Their use signals that private markets are either unwilling or unable to absorb risk at current prices. It is a subtle yet powerful message that the pricing of risk has been disrupted and that the usual channels of capital allocation are temporarily impaired to the attentive observer. These episodes are not just about short-term funding, they are windows into the stress points of the financial ecosystem, revealing where leverage, liquidity mismatches, and market assumptions have reached their limits. When banks lean on the Fed, it demonstrates that stability is conditional and not absolute, creating both caution and opportunity for those analyzing the system. The narrative becomes even more compelling when viewed through the lens of human behavior and institutional incentives. Periods of apparent calm often mask the accumulation of risk. Easy liquidity conditions encourage institutions to increase leverage, extend asset durations, and chase yields with the assumption that markets will remain orderly indefinitely. This behavior inflates both perceived profitability and systemic vulnerability simultaneously. When conditions abruptly change through sudden market moves, policy shifts, or margin calls, the same strategies that amplified returns become accelerants for stress. Emergency borrowing, in this context, becomes a bridge between the assumptions of yesterday and the harsh realities of today. The hook here is undeniable. What appears as stability can often be the calm before a storm, and central bank support may simply postpone an inevitable adjustment. For investors and market participants, the lesson is subtle but critical. These liquidity interventions are more than stopgap measures. They are rich signals revealing where pressure is accumulating and where risk is being underpriced. Observing which institutions seek assistance, which assets are being liquidated, and how counterparties respond provides early insight into structural weaknesses. It highlights which positions are overextended, which strategies are reliant on continuous support, and which sectors may face sudden repricing. Those who interpret these signals correctly gain a strategic advantage, while those who rely solely on headlines or superficial assurances are left reacting rather than anticipating. In economics, the most important warnings rarely arrive as loud alarms. They manifest as shifts in behavior. subtle changes in market flows, and the sudden appearance of emergency interventions that expose hidden vulnerabilities. The moment banks quietly tap central bank liquidity, the system is sending a message that demands attention, offering an unmissable opportunity for disciplined observers to understand the hidden dynamics shaping markets and to position themselves wisely for what comes next. Highly leveraged positions represent one of the most potent amplifiers of systemic risk in modern financial markets. Leverage allows institutions to magnify returns on capital, but it does so by layering exposure on top of exposure, often in ways that are not immediately visible to outsiders. The allure of leverage is simple. With a relatively small amount of capital, investors and banks can control positions many times larger, reaping profits when markets move in their favor. Yet the same tool that creates outsized gains also accelerates losses when the unexpected occurs. This dual nature is what makes excessive leverage so dangerous, particularly when concentrated in crowded trades or in speculative positions. The hook lies in understanding that leverage is not inherently bad. It is a tool, but the scale and not opacity of its use can transform minor shocks into market-wide upheavals. But when financial institutions engage in leveraged short positions, as in the case of crowded bets against silver, the mechanics of loss magnification become clear. Each percentage point of adverse price movement does not impact only the initial capital, it cascades through the multiple layers of borrowed funds, amplifying the financial strain. Small miscalculations or unexpected market reactions can rapidly deplete equity, forcing forced liquidations. These liquidations, in turn, impact prices further, creating a feedback loop where losses accelerate in a self-reinforcing cycle. Observers who focus solely on market direction often miss the structural risk embedded in leverage. The system itself becomes a catalyst for volatility, not just the underlying asset. What makes leverage even more perilous is the illusion of stability during periods of calm. When markets trend smoothly, highly leveraged positions appear sustainable, and institutions grow increasingly confident in maintaining or even expanding their exposure. This confidence, however, masks the fragility underneath. Volatility may be artificially suppressed by central bank policies, low interest rates, or high liquidity, encouraging risk-taking behavior that is unsustainable in a stressed environment. The hook is that the very conditions that appear supportive, low borrowing costs, abundant capital, and positive momentum, are often the same conditions that set the stage for sudden unraveling. Leverage thrives in calm, but collapses in turbulence. Furthermore, concentrated positions magnify systemic implications. If multiple institutions pursue similar strategies, market stress is no longer isolated, it becomes networked. When short positions are crowded, a price move in the opposite direction can trigger a chain reaction of margin calls, forced buying, and liquidity withdrawals. This is what transforms a single risk into a collective crisis. Observers who understand this dynamic recognize that market moves are rarely purely random. They are often the consequence of structural imbalances built over months or years. The moment leveraged shorts begin to unwind, the market becomes a pressure cooker where every participant's actions amplify the consequences of others. The psychological dimension of leverage further intensifies risk. Decision makers often rely on models, historical trends, and assumptions about liquidity and market behavior that break down under stress. Overconfidence, herd behavior, and the reluctance to accept small losses exacerbate the fragility. The hook is that the combination of human psychology and financial mechanics creates a potent recipe for rapid market dislocations, where outcomes can exceed even the most pessimistic projections. For investors and policymakers, understanding leverage is crucial because it highlights vulnerabilities invisible to traditional metrics. It explains why institutions that appear healthy on a balance sheet can become distressed overnight, and why markets can experience extreme volatility even in the absence of fundamental shocks. Those who recognize the mechanics of leverage and its capacity to amplify both gains and losses are better positioned to anticipate stress points, identify mispriced assets, and navigate periods of instability with discipline rather than panic. Leverage, when unchecked and concentrated, is not just a tool, it is a magnifier of systemic truth, revealing the hidden fragility of a market that often appears invincible until its end markets have a natural way of punishing consensus when it becomes extreme. And crowded trades are a vivid example of this dynamic. A crowded trade occurs when A significant number of participants align on the same market position, whether long or short, creating an artificial concentration of risk. While this can produce stable or even predictable price behavior, in the short term, it also introduces fragility that few participants fully appreciate until the tipping point arrives. The most compelling hook in understanding crowded trades is that what seems like collective wisdom can quickly transform into collective vulnerability. And the more crowded the position, the faster the unwind can escalate into a cascade of losses worse. In the case of heavily shorted assets, such as silver, in recent market turmoil, the concentration of bearish positions creates a precarious situation. Each incremental move against the short position forces participants to adjust rapidly, often triggering margin calls or stop-loss executions. What begins as a minor repricing can snowball, producing sharp price swings that appear proportionate to any fundamental change. The key insight is that the market does not react solely to fundamentals, it reacts to positioning, leverage, and the interdependencies of participants' strategies. When a trade becomes crowded, the risk of self-reinforcing feedback loops grows exponentially, turning what was perceived as a low probability outcome into a near certainty. The illusion of safety in crowded trades is deceptive. Market participants often justify their positions through historical data, trend analysis, and peer behavior, assuming that liquidity will remain ample and that opposing forces will be limited. These assumptions, however, overlook the inherent instability that arises when too many actors rely on the same narrative. The hook here is that confidence among traders amplifies vulnerability. The stronger the belief that the trade will succeed, the greater the potential shock when reality diverges from expectation, when liquidity is suddenly constrained, or unexpected demand emerges. The crowded position can collapse in a matter of hours, catching even seasoned investors off guard. Crowded trades also reveal the structural limits of risk management practices. Traditional risk models may fail to account for the speed and magnitude of unwind in a highly correlated environment. Stress tests designed for isolated shocks cannot always anticipate the cascading effects of a collective exit from an all-overcrowded position. Observers who recognize this understand that the market is not merely a collection of independent actors, but a network of interconnected positions, each capable of amplifying the impact of the others. The hook is subtle but crucial. Risk is not just about exposure to an asset, it is about exposure to the behavior of all participants who share your position. Furthermore, the dynamics of crowded trades illustrate why markets can be both efficient and irrational simultaneously. On one hand, prices may reflect supply and demand fundamentals in the long run. On the other hand, the short-term movements can be dominated by positioning pressure, liquidity constraints, and herd behavior. When the crowd begins to exit the crowded short, the resulting price movement can seem disconnected from fundamentals, creating an illusion of chaos, while in reality, the market is simply correcting imbalances that were building unnoticed. The lesson for investors, policymakers, and analysts is that extreme consensus is rarely sustainable. Crowded trades are warning signals, highlighting areas where liquidity, risk, leverage, and positioning may interact to produce outsized volatility. Those who can identify these imbalances early, monitor market positioning, and anticipate the potential for rapid unwinds are better positioned to navigate turbulence. The hook is that opportunity and risk coexist in crowded trades, and the same forces that make a trade profitable in calm conditions can convert it into a source of rapid losses when stress arrives. Observing and understanding the structure of market consensus allows one to act strategically, rather than react emotionally when crowded trades inevitably unwind. But liquidity is often described as the lifeblood of financial markets, yet its true significance extends far beyond the ability to convert assets into cash. At its core, liquidity is confidence in disguise, a reflection of trust among participants that obligations can be met, positions can be adjusted, and transactions can occur without disruption. When liquidity dries up or becomes dependent on central bank intervention, it signals that confidence, rather than capital, is under strain. The hook here is profound. Markets do not fail solely because of shortages of money. They fail when belief in the stability of counterparties, instruments, and systems erodes. Observing liquidity flows provides insight into hidden stress points that traditional balance sheet metrics often obscure, offering a lens into the real vulnerabilities of the financial ecosystem. When banks turn to emergency facilities for short-term funding, the act itself communicates more than any press release. It reveals that private markets are either unwilling or unable to provide capital at prevailing rates, suggesting an underlying reluctance to assume risk. The subtle yet critical detail is that this reluctance does not appear in isolation. It reflects widespread uncertainty about asset quality, exposure levels, and counterparty reliability. Each borrowing event exposes not just the individual institution's vulnerability, but also the limits of market trust. The hook is that liquidity interventions are like stress tests in real time. They illuminate which structures are fragile, which positions are overextended, and which assumptions about market efficiency no longer hold. Liquidity crises also highlight the interconnectedness of modern financial systems. Banks, hedge funds, and other financial intermediaries are linked by layers of obligations, derivatives, and credit exposures. When confidence falters in one corner of the market, it can cascade, forcing participants to adjust positions, raise collateral, or seek alternative funding. This ripple effect amplifies pressure, revealing the systemic nature of liquidity. The hook in this dynamic is that small disruptions can escalate quickly when trust is absent. What begins as a minor withdrawal or market hesitation can lead to widespread stress, underscoring the importance of observing liquidity as both a quantitative measure and a qualitative indicator of market sentiment. Another critical aspect is the temporal dimension of liquidity. Access to funds is not merely about whether money exists somewhere in the system, it is about whether it can be deployed quickly enough to meet obligations. Timing becomes a weapon, and delays can magnify losses. This is why central bank facilities are structured to provide immediately. Support speed matters as much as quantity. The hook here is that liquidity is fundamentally about responsiveness. The market's ability to act under pressure is what differentiates resilience from fragility. Institutions with ready access to capital are not just richer, they are more trusted, more agile, and better positioned to navigate volatility. Behavioral factors play an equally important role. The perception of liquidity can be as impactful as actual cash availability. If market participants doubt that others can or will meet their obligations, confidence erodes and liquidity effectively vanishes. Panic, hesitation, or skepticism can freeze transactions even when adequate resources exist, revealing that trust is both an asset and a constraint. The hook is that liquidity is not a static measure, it is dynamic, psychological, and highly sensitive to perception. Observers who understand this can anticipate stress points before they manifest in overt market moves. Finally, liquidity dynamics illustrate a broader economic truth. The health of financial markets depends as much on belief and behavior as on capital structure. When markets require external intervention to function, it is not merely a temporary fix, it is a signal that the private system has reached its operational limits. Those who track these signals closely gain an informational advantage, identifying where risk is accumulating, which assets are mispriced, and where opportunities for strategic action exist. Liquidity, therefore, is not just a tool, it is a revealing indicator of confidence, systemic resilience, and hidden vulnerabilities, and understanding it provides both foresight and a tactical edge in navigating complex financial environments. But unlike paper instruments, which can be created, traded, and leveraged with relative ease, real assets operate under immutable physical constraints. Silver, gold, commodities, and even real estate cannot be expanded at will to meet the demands of speculative markets. The hook here is simple but profound. While financial engineering can create the illusion of infinite supply through derivatives, rehypothecation, or synthetic exposure, the underlying scarcity of real assets imposes a hard limit that no financial model can override indefinitely. When markets become excessively short or over-leveraged against these tangible assets, corrections are not just possible, they are inevitable, and their magnitude is often far greater than participants anticipate. The pressure on real assets becomes particularly acute when derivatives markets misrepresent supply and demand dynamics. Synthetic positions, futures contracts, and paper claims on silver or gold can multiply far beyond the actual quantity of the physical commodity. Traders may feel confident in controlling large positions with minimal capital because they are relying on the liquidity and fungibility of the paper market rather than the physical reality. The hook here is that when the divergence between paper claims and physical availability becomes too great, even minor shifts in demand, inventory, or industrial usage can trigger rapid and unexpected repricing. The market is then forced to reconcile abstract speculation with tangible reality, and this reconciliation is rarely smooth. Industrial and commercial demand adds another layer of constraint that amplifies the fragility of highly leveraged positions. Unlike financial derivatives, physical metals and commodities have ongoing functional uses that cannot be ignored. Silver is not merely an investment vehicle. It is essential in electronics, solar energy, and medical applications. When short positions fail to account for these real-world constraints, they underestimate the speed and intensity with which markets can correct. The hook is that markets eventually bow to reality, and speculation that ignores the fundamental drivers of scarcity is vulnerable to sudden, severe reversals. Historical patterns illustrate that markets frequently attempt to suppress or manipulate prices for strategic advantage, yet these efforts encounter the ultimate limit of supply. Central banks, large institutions, or market makers may intervene temporarily to influence prices, but they cannot create new silver or gold out of thin air to satisfy artificially imposed positions. The hook here is that attempts to control price through financial engineering are inherently unstable. They rely on continued confidence and liquidity, both of which can evaporate quickly under stress, exposing the true scarcity of the asset. The moment physical constraints clash with financial constructs, volatility spikes, and overextended positions unwind violently. Behavioral factors compound the instability of markets when real assets are involved. Traders often rely on assumptions that paper markets are sufficient proxies for physical supply, ignoring the limitations imposed by delivery requirements, inventory shortages, or industrial consumption. This overconfidence fuels crowded trades, excessive shorts, and complex derivative strategies that appear sustainable until reality asserts itself. The hook is that psychological over-reliance on abstractions makes participants blind to risk, and the resulting mispricing creates both peril and opportunity for those who understand the underlying fundamentals. Observing real asset markets offers a lens into the broader interaction between finance and reality. When derivatives and speculation dominate trading behavior, the price signals generated by paper markets can diverge significantly from scarcity-driven fundamentals. Yet, when imbalances reach a tipping point, the reconciliation is swift and often dramatic, highlighting that real assets cannot be infinitely engineered away. The hook is that tangible scarcity enforces discipline on markets in a way that paper instruments never can, rewarding those who understand the constraints and punishing those who ignore them. Understanding this dynamic is critical for anticipating volatility, evaluating risk, and positioning strategically in markets where physical reality ultimately governs value. Economic turning points and financial crises rarely reward those who react impulsively to headlines or tend to predict every market movement. True advantage belongs to those who understand the interplay of incentives, balance sheets, and structural imbalances that underlie market behavior. The hook here is that survival and prosperity in volatile markets depend less on prediction and more on preparation, on cultivating a disciplined approach that anticipates stress rather than being surprised by it. Those who master this mindset can navigate turbulence with composure, turning periods of upheaval into opportunities for strategic positioning. Long-term resilience is built through the careful assessment of risk and an appreciation of asymmetry. Market participants who fail to recognize the limits of leverage, liquidity, and concentration expose themselves to sudden losses that can wipe out years of gains. Conversely, those who monitor exposure, stress test assumptions, and maintain flexibility are better positioned to respond. When volatility accelerates, the hook here is that opportunity and danger coexist in every market movement. And those who understand asymmetry, where potential loss is limited but potential gain is substantial, can profit even when broader markets panic. Preparation, not prediction, is the mechanism that converts risk into strategic advantage. Observing structural imbalances is central to disciplined financial thinking. When institutions accumulate concentrated positions, when leverage grows faster than equity, and when liquidity depends on central bank intervention, signals emerge long before they are visible in price charts. The perceptive investor interprets these signals as warnings and opportunities, recognizing that the market's reaction to stress will be sharper and faster than conventional analysis suggests. The hook is that structural imbalances rarely manifest gradually. They accumulate silently until external shocks trigger abrupt corrections, rewarding those who anticipated the buildup and punishing those who ignored it. Human behavior amplifies the consequences of these imbalances. Herd mentality, overconfidence, and the tendency to follow prevailing narratives contribute to the severity of corrections. When markets are crowded with participants taking similar positions, the unwinding of those trades can trigger cascading effects far beyond what fundamentals alone would dictate. The hook is that understanding psychology is as important as understanding numbers. Market behavior is driven not only by supply and demand, but by the collective decisions, biases, and emotions of participants who often underestimate risk until it is too late. Disciplined positioning also requires recognizing the difference between temporary disruption and structural change. Not every market shock is a signal to abandon long-term strategies. Some events are transient, offering opportunities to enter undervalued positions or reduce exposure to overextended assets. The perceptive participant distinguishes between panic-induced volatility and genuine shifts in fundamentals. The hook is that those who can maintain perspective amid noise gain the ability to act decisively, while others react emotionally, turning uncertainty into advantage. Finally, preparation involves cultivating knowledge, patience, and strategic foresight. The market does not reward those who chase every headline, it rewards those who understand incentives, anticipate stress points, and maintain disciplined allocation of capital. Those who survive and thrive are the calm, methodical participants who recognize that volatility is not a threat to be feared, but a mechanism that reveals hidden truths about the system. The hook is that resilience is not accidental. It is cultivated through careful observation, disciplined planning, and the ability to act when structural signals, rather than superficial noise, indicate opportunity. In this way, economic turning points reward preparation over prediction, insight over impulse, and disciplined understanding over blind speculation, creating an enduring advantage for those who position themselves wisely before the storm arrives. So let this moment motivate you, not frighten you. Let it sharpen your focus, not scatter your attention. When you hear that banks are tapping emergency facilities and crowded trades are collapsing, do not ask, "Is it over?" Ask, "What is being revealed?" Because every financial stress event pulls the curtain back just a little more. The future will belong to those who respect reality over reassurance, discipline over excitement, and long-term value over short-term comfort. Stay alert, stay patient, stay educated, because when the noise fades and the dust settles, those who understood the signal will not be surprised. They will be ready.